If I ask you who controls the amount of money in the world, you'll probably say the central bank. Maybe the government. Maybe the United States. But what if none of them are truly in control? The real power sits somewhere most people never look. And that's the story we're about to unfold. Every time inflation rises, the news shows the same image. A central bank governor, an interest rate announcement, a press conference. It feels like the global economy lives inside one conference room. But that picture is incomplete. And right now, in the post-2020 world, after trillions were created, after rates dropped to near zero, after sudden banking shocks, this question matters more than ever. Who actually controls the global money supply? Let's start with something simple. A bank loan. You walk into a bank. You borrow $100,000. Most people imagine the bank hands you someone else's deposited money. But in modern banking, that's not what usually happens. When a bank issues a loan, it creates a new deposit in your account. A new digital balance. New money. That money didn't move. It was typed into existence. This isn't conspiracy, it's accounting. In most modern economies, over 90% of money isn't physical cash. It's bank deposits. And deposits are largely created when banks issue loans. So here's the first uncomfortable shift. Central banks don't directly create most of the money people use. Commercial banks do. But does that mean banks are in control? Not entirely. What does a central bank actually control? Interest rates, bank reserves, liquidity during crises. It sets the conditions, it prepares the field, but the players? They're the commercial banks. When interest rates are low, borrowing is cheap. Businesses expand. People buy homes. Investors leverage up. Loans increase. Money expands. When rates rise, borrowing slows. New money creation cools. But there's another layer most people miss. Banks don't lend based on social need. They lend based on profitability and collateral. That means most new money doesn't flow evenly into the productive economy. It flows into assets, real estate, stocks, financial instruments. So when money supply expands rapidly, asset prices often rise first. This is why periods of easy money tend to coincide with soaring housing markets and booming stock indexes. It's not magic. It's plumbing. Now let's zoom out. The US. The dollar sits at the center of the global system. Much of international trade is denominated in dollars. Oil, sovereign debt, corporate bonds. When the Federal Reserve raises rates, capital often flows toward the United States. Emerging market currencies weaken. Dollar-denominated debt becomes more expensive to service. One country's policy reshapes global liquidity. So now we have multiple layers. Central banks setting conditions, commercial banks creating credit, financial markets reallocating capital globally. But here's the deeper mechanism. Money supply isn't controlled by a single lever. It's shaped by incentives. Central banks want stability. Commercial banks want profit. Governments want affordable financing. Investors want returns. When low rates benefit everyone in the short term, credit expands. Debt builds. Asset prices inflate. Rewards expansion. Until it doesn't. When confidence cracks, banks tighten lending. Markets fall. Credit contracts. Money seems to disappear. It doesn't literally vanish. Loans are paid down or defaulted on. Leverage unwinds. Balance sheets shrink. The same mechanism that amplified growth now amplifies contraction. Public narratives simplify this too. The central bank printed too much money. But most money wasn't printed. It was lent into existence. And it exists only as long as borrowers can repay and lenders remain confident. This is a credit-based system, built on expectations about the future. If businesses believe tomorrow will be better, they borrow. If investors believe prices will rise, they allocate capital aggressively. If banks believe risk is manageable, they expand balance sheets. Money grows. But if doubt spreads, cut rates. They can inject liquidity. They can buy assets, but they cannot force confidence. So who controls the global money supply? On paper, central banks. In practice, commercial banks through credit creation. In reality, the interaction between incentives, risk perception, and global capital flows. It's not a single institution. It's a network. And perhaps the most powerful force in that network isn't a central banker or a finance minister. It's collective belief. Because in a system where most money is created through debt, control ultimately rests on one fragile variable. Who believes the future is worth borrowing for, and for how long? If you want to understand how money really works, subscribe now.